Welcome to Ulosca channel. Access all WGU practice questions. Finance skills for managers practice questions with answers.
Question 1. The main purpose of financial management in an organization is to A. Maximize employee satisfaction. B. Minimize operational costs only. C. Maximize shareholder wealth. D. Focus solely on revenue growth. Which one is the correct answer? The correct answer is C. Maximize shareholder wealth. Explanation. The ultimate goal of financial management is to maximize shareholder wealth, meaning increasing the value of the business for owners and investors. While cost control, revenue growth, and employee satisfaction are important, they are means to achieve wealth maximization, not the end goal. Question 2. Which of the following is a key component of working capital management? A. Long-term bonds. B. Current assets and current liabilities. C. Fixed assets. D. Equity financing. Which one is the correct answer? The correct answer is B. Current assets and current liabilities. Explanation. Working capital management focuses on short-term financial health by managing current assets and current liabilities. This ensures liquidity and smooth daily operations. Question 3. The balance sheet provides information about A. Revenue and expenses over a period of time. B. Cash inflows and outflows during a period. C. Assets, liabilities, and equity at a specific point in time. D. Changes in retained earnings only. Which one is the correct answer? The correct answer is C. Assets, liabilities, and equity at a specific point in time. Explanation. A balance sheet is a snapshot of a company's financial position at a given date, showing what it owns, owes, and the residual interest of shareholders. Unlike income statements, it does not track performance over time, but at a specific point. Question 4. Which financial ratio is used to measure a company's ability to meet its short-term obligations? A. Debt-to-equity ratio. B. Current ratio. C. Return on equity. D. Profit margin. Which one is the correct answer? The correct answer is B. Current ratio. Explanation. The current ratio compares current assets to current liabilities, indicating whether the company has enough liquid resources to cover short-term debts. It is a key measure of liquidity and short-term solvency. Question 5. A company's cost of capital represents A. The cost of producing 1 unit of goods. B. The minimum return required by investors and creditors. C. The cost of paying employee salaries. D. The expenses related to day-to-day operations. Which one is the correct answer? The correct answer is B. The minimum return required by investors and creditors. Explanation. Cost of capital is the minimum rate of return a company must earn to satisfy its investors and creditors. It reflects the opportunity cost of investing funds in the business versus alternative investments. Question 6. The time value of money concept states that A. Money today is worth more than the same amount in the future. B. Money in the future is more valuable than today. C. Money has the same value regardless of time. D. Money only gains value with inflation. Which one is the correct answer? The correct answer is A. Money today is worth more than the same amount in the future. Explanation. The principle of time value of money explains that money today can be invested to earn returns, making it more valuable than receiving the same amount in the future. This is the foundation for concepts like discounting and compounding. Question 7. If a project's net present value is positive, it indicates that A. The project is expected to lose money. B. The project should be rejected. C. The project is expected to add value to the firm. D. The project's return is equal to the cost of capital. Which one is the correct answer? The correct answer is C. The project is expected to add value to the firm. Explanation. A positive NPV means the present value of cash inflows exceeds the outflows, showing the project adds value to shareholders. Firms generally accept projects with positive NPVs since they generate returns above the cost of capital. Question 8. Which type of budgeting starts from zero and requires justification for all expenses? A. Static budgeting. B. Flexible budgeting. C. Zero-based budgeting. D. Incremental budgeting. Which one is the correct answer? The correct answer is C. Zero-based budgeting. Explanation. Zero-based budgeting requires every expense to be justified as if starting from scratch, instead of using last year's figures. This approach prevents unnecessary expenses and encourages efficiency. Question 9. Which financial statement shows a company's performance in terms of revenues and expenses? A. Balance sheet. B. Statement of cash flows. C. Income statement. D. Statement of retained earnings. Which one is the correct answer? The correct answer is C. Income statement. Explanation. The income statement reports revenues, expenses, and net profit loss over a period. It is the key tool for evaluating financial performance and profitability. Question 10. A higher debt-to-equity ratio generally indicates A. Lower financial risk. B. Greater reliance on debt financing. C. Higher liquidity. D. Stronger equity financing. Which one is the correct answer? The correct answer is B. Greater reliance on debt financing. Explanation. A high debt-to-equity ratio signals that a company relies heavily on borrowed funds. While this can amplify returns, it also increases financial risk since obligations to creditors must be repaid regardless of business performance.
Thank you for watching. For more practice exam questions, subscribe to our website at www.ulosca.com.